So what's exactly going on with Credit Suisse right now? So it's all to do with capital ratios. A capital ratio basically measures the amount of assets to liabilities that a corporation or a bank holds. These are designed so that a bank is never overexposed and is able to respond to crises. Let's have a look at this for example. Credit Suisse currently have a 13.5% capital ratio. What that means is if Credit Suisse have liabilities of £150,000 and they want to retain a capital ratio of 13.5%, they would need around £20,250 in assets. And the equation to work out capital ratios is on the board. So we do assets divided by liabilities times by 100. Now, capital ratios change in response to risk and to the market conditions at the time. And what do we know about the markets at the moment? Well, they're quite risky. So that means that capital ratios should really be going up. Additionally, the central bank, for example in the UK, can set a base rate of your capital ratio. For example, in the UK, we have rates of 4.5, 6 and 8%, depending on the capital you're using in your accounting principles. What happened with Credit Suisse was Deutsche Bank, who themselves have come under trouble in the last couple of years, have basically said that this 13.5% is not high enough. They need to boost up that capital ratio. In fact, Deutsche Bank have suggested that Credit Suisse should raise their capital ratio by around 4 billion Swiss francs. So what does that actually mean? That means that Credit Suisse have to purchase more assets in order to equate for their liabilities in order to increase this capital ratio. But of course, to do that, they need money. So where do they get that money from? Well, they could get it from investors, and this is where the problems begin. Credit Suisse has been having a hard time of it recently. There's been lots of scandals, and also their wealth management division hasn't been performing as well as it could be. So it doesn't make it a very hot investment anyway. Moreover, their share price is down 25%. So Credit Suisse can't raise the extra income needed to purchase these assets through issuing shares because they don't get the same revenue from issuing those shares that they did, say, a year ago. Combine this all then with a load of people in the meme stock community jumping on the trend and saying that Credit Suisse is the next Lehman Brothers and that it's going to go bankrupt, and you see that confidence is at an all-time low. This has resulted in an all-time high for the price of credit default swaps on bonds issued by Credit Suisse. Now, a credit default swap, a CDS, is a financial derivative. It works a bit like insurance. If I'm the person that holds a corporate bond from Credit Suisse, I might be a bit uncertain about where that bond's going to go, whether they're going to be able to pay me, whether they'll keep paying the coupons. So what I'm going to do is I'll offer you a set premium to offer me insurance, so you then back me up in case that bond goes down the drain. Obviously, when there's more risk, the insurer, if we can call them that, is going to want a higher premium. They're going to want a higher price. And that's exactly what we've seen with Credit Suisse credit default swaps at the moment, because the price has been going through the roof. Have you heard of credit default swaps before? You may have done, because they're part of the cause of the 2008 financial crisis. In fact, the credit default swaps on Credit Suisse are at an all-time high. They're even higher than they were in 2008, during the financial crisis when we weren't sure which banks were going to go bust or not. Is all lost with Credit Suisse? Is the bank going to go bust? There are a couple of saving graces. The first being that Credit Suisse plans to sell its investment management division, and that's valued at around 2 billion francs. Remember, they need around 4 billion in order to reach the capital ratio. Compared with other European banks, the capital ratio of 13.5% is rather in keeping with those European banks. In fact, it's similar to the likes of the Union Bank of Switzerland, the Hong Kong Shanghai Banking Corporation, Deutsche Bank, and the Banque de Paris et de Paribas. When it comes to their liquidity ratio, which is the measure of the amount of liquid assets the bank has on hand to respond to crisis, Credit Suisse has a very high liquidity ratio versus other banks of 191%. In short then, there are some fundamental arguments why Credit Suisse should weather this storm. But the interesting thing to take away here is the role of confidence. And this links to what John Maynard Keynes described, one of the fathers of modern economics, as animal spirits. This is the idea that it doesn't take anything to be wrong with the economy or for a market or for a business in order for it to go bust. All that needs to happen is for people to think there's something wrong with that business or that market or that economy and to act in a way which then causes it to go bust. This is a really interesting economic phenomenon that we should all be aware of. So let me know your thoughts about Credit Suisse in the comments below. And also, if you want to support the channel, you can find links to my Patreon in the bio up above.